Okay, let's dive into this. Welcome to a breakdown of how the most sophisticated minds on Wall Street actually operate. Today, we're totally tearing down the wall between everyday trading and high-level quantitative finance. We're going to explore exactly how the world's top financial engineers navigate what is honestly a super chaotic market. It sounds completely counterintuitive, right? I mean, most of us are conditioned to panic when we see a sea of red across our screens. But what if I told you that some of the wealthiest, most successful investors out there genuinely do not care if the broader market crashes or soars? Seriously, they make money either way. Today's explainer is going to show you exactly how they pull off this seemingly impossible feat. So, here is the roadmap for our explainer today. We're going to build this block by block. 1. Thinking like a quant. 2. Risk, return, and distributions. 3. Mastering the pair trade. 4. Building the optimal portfolio. And 5. The quant toolkit expands. All right, let's jump right into section 1, thinking like a quant. It's time to take off our traditional investor hats and put on our quant glasses. You know, there's a really massive divide in how everyday retail investors and quantitative analysts actually view the market. Most people, the retail investors, rely on directional bets. Maybe it's based on a news headline or a hunch or some market momentum. And crucially, they desperately need the market to go up to see any profit at all. But quants, they're fundamentally different. They use rigorous math, massive data sets, and artificial intelligence to construct these incredibly clever market-neutral strategies. Instead of just buying a stock and hoping for the best, they're placing complex bets using assets like currencies, options, futures, and swaps. This allows them to turn completely unpredictable market swings into reliable profit, absolutely regardless of which direction things are heading. And here's the thing. Quants definitely don't waste their time trying to draw trend lines through jagged, unpredictable price charts, like a 2024 Apple stock chart, completely useless for predicting the future. Instead, they simplify things by entirely focusing on the daily return. That's just the percent change from day to day. Doing this transforms that chaotic, directional price action into standardized, stationary data that mathematical models can actually, digest. Which brings us to section 2, risk, return, and distributions. By looking at the data differently, we start to uncover some amazing hidden structures. So imagine a plot of daily returns. Most days, it's just a scattered, chaotic mess of dots above and below zero. Looks totally random. But here is where things get truly fascinating. If we change our perspective, if we take those daily returns and stack them into a histogram, grouping the negative, near zero, and positive returns, a very recognizable pattern suddenly emerges. You get this shape that is incredibly tall right in the middle, around the zero mark, and much, much shorter out at the extreme ends. Does that shape sound familiar? That maps directly to the famous normal distribution, the good old bell curve. Whether we're talking about Apple, Nvidia, Meta, Google, or Amazon, their daily returns resemble this exact same curve centered around zero. And just like that, market chaos is literally reduced to just two manageable variables: the mean, which represents our expected return, and the spread, or standard deviation, which is exactly what quants define as risk. But obviously, the market isn't just one single stock, right? There are thousands, and they very often move together. This is where correlation comes in. It measures the degree to which two stocks tend to move in tandem. When quants model two stocks together, this math becomes a higher dimensional normal distribution. Picture it like a 3D surface. If you look at it from the side, you see a standard bell curve. But if you look straight down from above, you don't see a perfect circle, you see an oval. And that stretched oval visually represents the correlation between those two assets. Let's transition to a real-world scenario in Section 3, Mastering the Pair Trade. Let's see how we actually make money off these models even when the whole market is falling. So the absolute secret weapon here is short selling. Let's demystify this for a second. Quants don't just use short selling to bet against bad companies. They use the cash generated from selling borrowed shares to actually fund their other positions. This mechanism is the crucial bedrock that allows professionals to detach their profits from the broader market's overall direction. And this brilliantly illustrates the pair trade. Let's say our models predict a stock called Alpha will outperform a stock called Omega. Alpha is at $50, Omega is at $40. We short 25 shares of Omega for $1,000, and we immediately use that cash to buy 20 shares of Alpha. Notice what happened. We haven't spent a single dime of our own money. Now, 3 months later, let's say the market totally tanks. Both stocks drop $5. We sell Alpha for $900, we buy back Omega for $875 to close our short, and boom, we pocket $25 in pure profit. But why? Because alpha dropped 10%, well, omega dropped 12.5%. Alpha outperformed omega. We just engineered a profit out of a total market crash. Now, what's really interesting is how we take that elegant little pair trade and scale it up to something massive. Let's dive into section 4, building the optimal portfolio. If we want to construct a portfolio of, say, the entire S&P 500, we aren't just comparing alpha and omega anymore. We are dealing with massive, massive dimensions. To build a 500-dimensional normal distribution, quants need to figure out 500 means, 500 standard deviations, and, get this, nearly 125,000 separate correlation values just to map how every single stock interacts with every other stock. That is an immense mathematical burden. But contrast that huge requirement with this stark reality. A typical trading month only provides about 21 days of data. So for 500 stocks over a month, you only have 10,500 daily returns to analyze. That is nowhere close to enough raw data to confidently estimate those 125,000 correlation values. This data shortage is a classic example of what industry professionals call the curse of dimensionality. It essentially proves that we are incredibly short on data, and quants can't just rely on basic math. They need far smarter models and clever statistics to fill in all those gaps. So to organize all this chaotic math and find the perfect balance between risk and reward, quants use a technique called mean variance optimization. I'll walk you through it step by step. First, they take all those estimated returns and bundle them into a single list of 500 numbers called a return vector. Second, they take all the standard deviations and those thousands of correlations and lock them into a massive 500 by 500 grid known as a covariance matrix. But there's still a missing puzzle piece. How much of our total money actually goes into each specific stock? To solve this, they apply a weight factor, which is just a list of percentages dictating our exact capital allocation for each company. So the crucial point here is how we tie all these vectors and matrices together. Quants use what's called an objective function. This is amazing because it literally translates our human preferences into strict math constraints. We obviously want to maximize returns, so that part of the formula is positive. We hate risk and uncertainty, so we subtract the risk, and we adjust that risk based on a risk aversion multiplier. Think of it basically as a dial that says exactly how cautious we want to be. Before a computer solves this, quants add constraints. Like, do we want a long-only portfolio where we only buy? Or do we want to stay totally market neutral, perfectly balancing our longs and shorts so the broader market's movement doesn't affect us at all? The objective function crunches the whole shebang to find the absolute mathematically optimal portfolio. All right, let's move to our final section to see how quants execute these massive optimizations today. Section 5, the Quant Toolkit expands. Calculating an optimal portfolio by hand? Completely impossible today. Literally, no one is manually entering 500 complex trades. Today, simple, automated Python scripts execute the entire process in seconds. But quants aren't stopping there. The toolkit is aggressively expanding. They're utilizing machine learning to tap into alternative data. Or talking about scraping credit card transaction data to instantly track shifting consumer spending. They're buying geolocation data from mobile devices to monitor foot traffic outside of retail stores before earnings reports are even filed. And then there's high-frequency trading. To give you an idea of the extremes we're talking about here, hedge funds have literally built line-of-sight microwave towers between Chicago and New York just to shave fractions of a millisecond off their execution times compared to fiber optic cables. They're spotting microscopic changes in supply and demand, racking up tiny, fractional profits thousands of times every single second. Whether they're using raw speed in high-frequency trading, scraping geolocation data, or just elegantly balancing bell curves to build the ultimate pair trade, the fundamental job of the quant remains exactly the same. It's all about finding hidden patterns. They're modeling uncertainty, and they're turning math into highly profitable trades, absolutely regardless of whether the market is booming or crashing. So the next time you see the stock market completely plummet and everyone is panicking, ask yourself, who is on the exact opposite side of that trade, quietly, mathematically profiting from the panic?